the last thing the world needs today is a currency war. That is really the last thing the global economy needs today. We live in a world of floating exchange rates. We live in a world where exchange rates are not and should not be targeted for competitive purposes. That's what the G20 and G7 have agreed. And let's just stick to that. And we've seen lots of volatility being created recently by different statements. I think that's not helpful. Any discussion on the exchange rate should be sent back to where it belongs, which is multilateral bodies, which is G7 and G20. And that's where the discussion should take place. Meanwhile, volatility is not helpful. And if that would reach a point where this would create any unwarranted consequence for us, any unwarranted tightening of our monetary policy, we would have to reassess.
Axel, the U.S. Treasury Secretary shows up and says, actually, a U.S. dollar weaker is better for trade. Then his boss says, well, but we're targeting maybe a higher dollar. Is that currency wars?
No, it's not. But, I think the U.S. position has always been very outspoken to focus on the strong dollar being in the interest of the U.S. If there is some deviation of that, markets are looking at that as well. Should we test that new proposition? So I think in the end, the U.S. will come back to the proposition that the strong dollar is in the U.S. interest. I think a strong currency is in the interest of many countries. But what monetary policy around the globe has been doing recently is actually, as part of quantitative easing, currencies that were particularly easing were actually also easing on the foreign exchange side. And one of the transmission mechanisms of quantitative easing is through financial markets. And if quantitative easing is done between two currencies, it can also affect the exchange rate.
Ray?
I think it's important to look at the mechanics of who determines where the currency movements are. A policymaker like the Treasury Secretary making a statement can affect the mood a bit. Central bankers can affect relative monetary policies, and so they can affect it. And then there are those who hold portfolios. They can hold reserves in currencies, and they have a big effect. And the portfolio is very skewed toward dollars and dollar assets, the world asset portfolio, even more than the currency mix. So the holding of dollar bonds, whoever is going to hold those dollar bonds, that's a pile of dollars for a long-term pile of dollars. And how you feel about those dollars bonds will affect it. I do believe that currency will be a big issue this year, as there's a reconsideration of how important the dollar is as a world's reserve currency.